Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at why IV matters the reversion, right? As we took the trade off for a very nice profit in a couple weeks on stable offshore SOC as IV, as anticipated, reverted very nicely indeed. The stock pretty much went nowhere, right? But we were able to capture a very nice profit based on that IV reversion. So let's jump in and take a look. First, here's the original kind of trade idea. You can take a look at the video we posted a couple weeks back to get a deeper dive into it. But basically, here's that big lift in IV based on big UOA, especially call volume, right? You can see IV absolutely just ripped higher here, especially on the long end. IV had jumped from the previous day to the day we put the trade on. You can see here IV at by far the big jump, right, going from just over 100 to 177, believe it or not. And that's all predicated on this big option volume, especially on the call side. IV percentile got to 72%. You can see the jump in IV from the previous day to that day. Here it is on the chart, right? Here's a 6-month chart of basically longer term, kind of at the money call IV hitting again the highest level we have seen in the past 6 months by far. On a longer term basis gives even a more pronounced picture, right? So IV getting to an extreme to say the least. Lo and behold, we're seeing IV as we anticipated come down. Here's where we put the trade on, right? Coming down sharply indeed, right? So selling options certainly made sense on that shorter term 6-month basis. Same idea here. This is a good time to be selling option premium in a somewhat neutral or hedge fashion, right? Once a reverse takes the trade off for a very nice gain. You can see IV percentile now at only 40%. Before, when we were putting the trade on, right, it was over 70, right? Volume 40 and 21 on the calls and puts. You can see more than a cut in half on that. So volume starting to ebb, which means IV starting to lower as things revert more towards normal. Here's the day we put the trade on at a 177. Didn't quite hit the top, right? But today at 138, certainly starting to soften. Here again is IV and finally starting to weaken. So that led to some very nice profits on a couple of our trades. So a simple one we did was a buy right trade right, going out and simply buying the stock and selling the call, right? Did the comparative back November 1st to January 2nd, right? And you can see that IV exploded on the trade, right? And with the stock actually going up in price from 1046 to 1173, the buy right got cheaper because the calls went up more than the stock did, believe it or not. Made that buy right 70 cents cheaper. We recommended buying that buy right, and then lo and behold, with that big drop today, you can see that buy right actually has improved dramatically. So the buy rate up 70 cents, even though the stock dropped. So before the stock went up, the buy rate got cheaper because IV jumped. Now with the IV drop, the stock went down, but the buy rate got more expensive, right? Able to take it off for a 70-cent gain, even with the stock down 50 cents. Why? The calls dropped 85 cents because of this nice drop of 7.5 vol points on IV. We kind of modeled it out here, right? Dropping to a similar level at 125, we'd expect the theoretical price on those calls to be about $4.05. They're at 4.05, so certainly that reversion led to a nice trade where we're able to have the stock actually drop a little bit, 15 cents, but the call we sold 2 weeks earlier, right, drop 85 cents because of that drop, that expected, right, big reversion in IV, right, led to the call dropping much more than the stock did, so the trade becoming a profit. Same thing on the strangle side. We had sold that strangle, the going out the same expiration January of 27, selling the $10 put, the $30 call for $8.90 on that big vol pop. Today, that trade only trading at about 735. We can go through the same sort of scenario here. The stock actually, dropped 15 cents, so virtually unchanged, right? But that strangle, you're able to pick up over $1.50. Why? Because IV on the strangle dropped over 17 vol points. So even though the stock was virtually unchanged, you'd have a little bit of time decay, right? But only 2 weeks on an option that doesn't expire until January of next year, right? All because we saw that IV, right, that we were able to sell up here and then cover down here. So hopefully explains how we go about identifying trade opportunities, doing it in a somewhat hedge fashion all the time, take advantage of the expected reversion in IV when it gets to an extreme. So until next time, as always, here's to good trading. Take care.